Hey guys, Adam Rose, Vice President, Senior Loan Officer for Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy Podcast. Today we're going to talk about non-QM and a little bit about construction loans. I felt like we've touched on non-QM before, not a ton, not a lot of in-depth, not saying we're going to go crazy today, but I feel last couple years there's been more of an appetite in the market for non-QM products, DSCRs, self-employment loans with 1099s or short self-employment history or debt ratio issues or things of that nature that we have to look at bank statement loans and other options and other full doc programs. And I want to touch on that again today because a lot of people in this market, there's a lot more side gigs going on that are kind of transitioning out of the typical 9 to 5 day work week into self-employment, right? People taking hobbies and creating businesses out of them, and it's taking up so much time that they decide to go in full time. And some of those people want to buy houses, right? It's just the way it is, and timing's not always on our side. And what I mean by that is when you go into self-employment, typically you need 2 years of tax filings, right, in order to figure out what the average income is over the last 2 years. And typically speaking, you lose money or make no money in the first year of a new business. That's typical because you have a lot more write-offs during that first year than most other years that are going to be following it. So there's other programs out there that can help fit you into that mold. So a couple of things. We have a great investor that has the SmartEdge program, SmartSelf program, and the SmartVest program. So let's chat about those a little bit. Now, the SmartEdge program is designed for near-miss programs like jumbos that didn't quite qualify. They're all manually underwritten. And specifically, which we run into every now and again, non-warrantable condos. Non-warrantable condos. So these are condo associations that may not have the insurance that they need for conforming lending, like your conventional USC, FHA, VA, or something going on. Maybe the amount of people that are owner ocs in that condo is not high enough to meet conforming standards. There could be a lot of things that kind of kick condo associations out, and so you have to go to a non-warrantable look. Now, I've done a couple of non-warrantable condos in the past, and with some of the investors, it was like 25 and 30% down. Well, our new investor, it could go up to 90% loan to value. It kind of just depends on credit score and some other qualifying factors, which I have a chart right here. But let's just say you have a 660, you can do 20% down. So again, it depends on credit mix and things of that nature, but that's still not too shabby. If you get over a 720, you could go up to 10% down. So that's on non-warrantable, which is a great program to put people into. 45% debt ratio, nothing too crazy on there. So I just wanted to make sure people are aware of that because there are a lot more condo purchases happening, and a lot of those associations haven't taken the steps or aren't aware of some of the steps they have to take to be approved from Fannie or HUD, and we have to take those steps, and sometimes we get bad surprises. So we have that as a backup option with a minimal amount out of pocket compared to some of the outlets that we've had before. Now, the SmartSelf program, that's self-employment, right? So talking about that briefly, not everybody's going to fit in that mold of the conforming programs. Again, when I say conforming, that's conventional, FHA, USDA, VA, 30-year fixed-rate mortgages, a little bit more aggressive on the rates. The SmartSelf is going to be designed for those people that are either, self-employed for a year, right? Or maybe a touch bit more. People that don't show a lot of income on their tax returns, right? Depending on the business you run. It might be a lot of cash business. You might have a lot of expenses. You show very, very little income, so your debt ratio is too far off. So the nice thing about bank statement loans, you can do a 12 and 24-month bank statement loan. 24-month bank statement loan is going to be a little bit more attractive rate-wise because there's less risk involved because you have more of a track record than the 12-month. But let's say 12 months, okay? So we're going to collect 12 months of bank statements, and we're going to do a calculation based off of your deposits into your bank account and give you a certain percentage of those deposits as income. I've had some self-employed borrowers that we showed $1,200 to $1,500 a month of income based off their tax returns. But when we go on the bank statement route, it was like triple. It was $4,000, $5,000. I've seen even more just because it's based off the deposits that are coming through, and they usually give you like 50% of the deposits as income because they know there's expenses involved. They do not introduce the tax filings. We don't want to introduce those. So very neat. And you can go up to 90% loan to value on that as well as a 10% down program. Again, depends on credit score, You can use it for primary residence, second home, investment properties, all of the above. Again, debt ratios matter. We don't want over 50%. Credit score matters. Okay, so the big thing here is if we have okay credit and we have some assets, there's an option out there for you. Okay, SmartVest program. Everybody's aware of these. It's a DSCR program. So the debt service credit ratio program is basically they prefer 1-to-1, but can go down to 0.8. So let me give you an example. Buying a house, let's say, or an investment property, and your mortgage payment is $1,000. Well, they want the cash flow or the rent on that property to be at least $1,000. They could go down as low as $800 a month. So you're losing $200 a month, and they will still close it. Very cool program. You're looking up to 85% loan to value. So minimum down payment is 15%. Again, got to check on your credit scores and things like that. Plays a role. But I think that's a very, very neat program. You can go up to $2 million on those. And it has some other cool little features to it, should I say, even if there might have been a late payment on a mortgage in the last 12 months, which is a scary thing. But that is an option. So I just wanted to throw that out to you guys. If you're a self-employed borrower watching this podcast right now or just wasn't aware that program was out there, again, they've been out there for a while, but a lot more traction in the last couple of years on these, bigger appetite in the market for it. And so I wanted to make sure people are aware that we can handle those. I usually don't peddle them too much just because it's a little bit of a different, it's outside the norm, right? It's a non-QM program or non-qualified mortgage, which is just non-traditional financing. So we just got to be careful. Takes a little bit longer, right? We gotta pay attention to all the little steps involved in your specific situation. Make sure we're not making any missteps or miscalculations. So that's the non-QM programs I want to make you guys aware about. And then I want to touch on construction loans. You know, it's July. We're moving into August here shortly. So if you were thinking about doing a construction loan, you still need to start planning. You might be lucky to get on the books in the spring, maybe summer of next year. All builders are a little bit different in regards to what they can handle, how much volume they can take on at the same time. But let's talk about that planning process, because too often are we getting someone that found lot and land that they want to buy, but they haven't even spoken to a builder. Okay. You don't want to get in that situation because the cost of a lot, the cost of land right now is extremely high. Okay, so it's going to limit the amount that you can build. So sometimes we got to pay attention to this to see if it makes sense or not. So step one, pre-approval, right? That's it. We're going to pre-approve you based off of an end loan amount, $500,000, $300,000, whatever it is that you can qualify for. Give you those parameters, okay? That's step one. Step two, and remember, we can do that through any program, right? USDA, FHA, VA, conventional, anything. So we're approving you for that end loan amount. Step two is meeting with that builder. All right. This is the biggest and slowest piece of this pie. Excuse me, I had to wet the whistle a little bit. So I can get you pre-approved. Hell, we can do it the same day, right? It's not a problem. That's the fast part. Give you some parameters to shop for. Meeting with the builder, finding the right builder for you, how they do business, their builds. Is it cookie cutter? Do they have plans? What are you looking for exactly? You're looking for a custom build. It's going to take a lot longer, right? So meeting with the builder, figuring out who you want to use, and then we can vet the builder. Very, very easy. But getting the plans and the specs, what's going in the house, right? All your specifications, what kind of countertops, what kind of cabinets, what kind of flooring, things that kind of bring the value or the quality piece to your appraised value. And then getting all that broken out in estimates, right? And then we will approve the project. And now, why do I say we will approve the project? Why isn't the builder approving it? Well, of course, the builder is approving it. So we approve the project. So what I mean is we're going to go through the estimates that you got, plan specs, everything. Make sure your elevations are there. All the plans are good. But the main thing we're looking for is make sure it's soup to nuts, right? Excavation, septic, well, framing, electrical, plumbing, all the rough ends, the finishing work, the final grade at the end, right? Bringing the dirt up to the house, seed and straw. So that's one of the biggest ones we run into. Seed and straw, a lot of builders don't want to deal with it. We prefer that it's in the estimate so we can deal with it, of course. And then the time of season is going to play a role, so we'll escrow for it, where you can just bring money, put it in an escrow account, we hold it. When it's ready to go, we pay it. But that's what we're looking for to approve the project, okay? that, and then we're going to work with your builder to work on their draw schedule to make sure you or I, as the lender, we're not upside down. Meaning, if they walked off the job, are we over leveraged? Did we lend too much money based off of what kind of finished product we have at that specific time? Okay, that's one thing buyers don't want to fight about with the builder, because it just seems like one of those silly things. But I can tell you from experience, I've seen it where builders have run off projects and took money. So you got to be very careful. Okay. Anyways, that's what I'm going to suggest. And then once we're done with all that, pre-approval, builder, plan, specs, estimates, approve the project. Now we're shopping for the lot. Now we're shopping for the land, because we want you to be able to build what you're wanting, right? And then finding the lot that fits, not the other way around. Okay, you might find a piece of land because it sounds great to go live on 20 acres, but if it's going to run you $200,000, that's going to cut into your building budget quite significantly. So that's something that we would prefer, that we have your end loan amount, we can work with your construction loan and your project. Then we're finding a lot that's going to fit inside this total loan amount, right? Unless you're buying in cash. Now, if you own land, that's great, right? You can build on your own lot, not a problem at all. We can use equity from your lot, assuming there is equity in your lot, to cover any kind of closing cost expense or small down payment holds or anything like that. So I just wanted to bring that up as well, so we're not making any kind of mistakes or getting in a hurry because we found the lot, we want to go to closing, we need to get this builder plans and specs and get all these estimates, and you feel like you made a mistake, or you feel you have regrets because the house wasn't big enough, or the style of home doesn't, you don't really like it that much, you just were in a hurry and you were just agreeable. We don't want that to happen. Nobody wants to take all that time, money, and effort and build your dream home when it's truly not your dream home, right? It's just not. There's something about it. So take those steps in planning. I'm personally in the planning process myself, and it's challenging, let me say. And it takes a lot of time. It does. So I hope that information was helpful, guys. Again, self-employed borrowers out there, non-warrantable condos, people that want to invest, we have great programs for you. If you want to call us, inquire. We can teach you a little bit about the program, what is expected of you, credit parameters, and all that. And if you're looking to build, guys, start the planning process now, getting on the books for spring and summer of next year for your new construction home. Okay. Remember, guys, subscribe on YouTube. Check us out on Spotify, Apple Podcasts, and we'll catch you all next week.